Welcome back to the Property Punch podcast. I'm Tabo, and with me, as always, I have my dad, property mentor and co-host, Washington.
It's great to be back. It's episode 17 already. Today, we're kickstarting our SMSF property pillar. It's a topic that I'm very, very excited and looking forward to covering with you.
I can imagine you're excited because this is what basically your whole career is based on.
It's been actually all my life. My life as a financial advisor, and then now my life as a property mentor. So yeah, really looking forward to that.
Today, we're answering one of the most searched questions in Australia. Can you use super to buy property?
So the short answer here is yes, you can. But the real answer is, it all depends on whether you've set up the right structure, you're following the rules, and whether it really suits your long-term strategy. The information discussed in this podcast today is general in nature and does not constitute personal financial, taxation, or legal advice. Please seek advice from a licensed professional before making any investment decisions.
I don't think there's such thing as a stupid question. And I can speak from experience that before we started this podcast, and even into the early episodes, I didn't really know what SMSF or a self-managed super fund actually was. So, to help everyone at home, let's answer that question, Dad. What is a self-managed super fund? And what is an SMSF property?
Thanks for the question. Basically, SMSF stands for self-managed super funds. It's quite self-explanatory. So instead of leaving your super to be invested at where it is, it could be a retail fund or an industry fund, you're managing it yourself.
Another maybe stupid question, but I don't believe any question is stupid. Before we talk about an SMSF, what is super? For those that don't know.
Never a stupid question. So superannuation is simply some money that is being set aside, mainly from your employer contributing. Now it's at least 12% of your gross income that you get paid. So every time you get paid, 12% of that income goes into a separate account called superannuation. And this is mainly being reserved to save for your retirement.
Okay, now with that, let's go back into the self-managed aspect of that.
So before we do that, so this account that I just mentioned, that the money is being put aside by your employer, normally the employer would put in mainly two types of accounts. One is called a retail fund, where you could nominate or you could choose some retail funds. There are quite plenty out there. Mainly they're owned by financial institutions like the Commonwealth Bank. Actually, they used to, now like MLC, AMP, TAO, and so forth. Those are called retail funds.
Mm-hmm.
Now, there are also other funds that are industry related. For example, if people work in the health industry, then most employers in the health industry will contribute into either the HESTA or the Aware Super. So those are mainly known as the health industry related super funds. And then there could be others like the RESTs, which is people who work in the retail industry. There's one fund called the RESTs Super, or people who work in the hospitality is called Host Plus. So mostly employers that are related in that, then they contribute into the Host Plus. And finally, another example is CBUS. So CBUS is mainly for people that work in construction. So those ones that I just mentioned are mainly called industry funds compared to the retail funds. So those are the two major types of super funds. So now when we talk about a third force, that's the self-managed super fund. And that's what we are talking about.
So what does it mean to have a self-managed super fund?
So simply what it means is that instead of that super being in a retail fund or in an industry fund, you are now managing it yourself. And when you're managing it yourself, you become what we call the trustee or the director of a trustee company if you've set up a company to do that. So you are now in charge of the day-to-day running of that fund. Secondly, you also control the investment decisions of that fund. And thirdly, you can now invest, in investments like shares and property. So when we're talking about an SMSF property, what it simply means is you are just, investing your superannuation by buying an investment property.
So it's not really a bunch of confusing loopholes trying to confuse people at home. It's a structure.
Exactly. It is a structure, and this structure is a legal structure. It's regulated, and there are some rules that you need to follow for it to be compliant, as well as it's regulated as well.
Well, I think you've already answered this question, but I think it's good to go deeper into it. Can you use super to buy property?
You know what? Absolutely you can. You can use super to buy property. However, there's some strict rules that you got to adhere to. For example, you cannot live in that property that you'd have bought. Anyone that you are related to can also not live in that property. And not under any circumstances can you use it for personal use. This property that you're investing in super must satisfy what we call the sole purpose test.
Mm-hmm.
And that sole purpose test is to make sure that any investment decisions that you're partaking are actually there to maximize your retirement fund.
So what you're saying is they want to make sure that this property is solely and only for investment purposes only.
Only that. And the reason why it's also being invested is to make sure that it's maximizing your superannuation so that you have enough money when you get older. In other words, the house that you buy is not a holiday home strategy.
With how much house prices are in Sydney right now, I can imagine that borrowing would have to be inevitable to afford an investment property. So can people using SMSF borrow to buy their investment property?
Absolutely. You're allowed to borrow. However, whatever you're borrowing has to be established in what we call the limited recourse borrowing arrangement. So this is simply a way to say that if you've got a superannuation fund, then the loan that you're borrowing is only attached to the property that you've bought and not any other assets of the superannuation account. So for example, if you fail to pay back to the bank what you're owing on that property, then that bank cannot touch any other assets of the SMSF that might be outside that property. For example, you might have some cash or some shares outside. So that's why it's called the limited borrowing recourse arrangement. There are some key differences between, if you are borrowing in your name compared to if you're borrowing through superannuation through an SMSF. And those differences are, there is usually a higher deposit that is required in self-managed super funds. That is minimum around 20 to 30% deposit. So if you're buying a property for, let's say, 500,000, you'll be needing a minimum deposit of around 100 to 150,000 minimum. There are also higher interest rates in self-managed super funds. And when banks are approving a loan, then they assess the SMSF income, not your personal income. So where does the SMSF income come from? Usually it will come from the rent that you are receiving from your tenant, plus also the employer super contributions and some voluntary contributions that you might be putting into your super, for example, through salary sacrifice or additional personal contributions as well. And finally, that property must be a single acquirable asset. So in other words, when you buy that property, you cannot subdivide to build another house at the back by using the borrowed funds. And you cannot do, major developments, for example, converting a one-story house into a double-story house. You cannot. So it has whatever amendments or whatever renovations that you're making, there has to be just for you to repair what's there. For example, an older kitchen, putting a newer kitchen, or changing carpet and painting. Just some minor cosmetic changes.
So what you're saying is borrowing inside of super is just more conservative.
It is very conservative because it's just designed to protect your retirement fund.
So far in our first segment, we looked over what an SMSF property is. And then you answered the question, can you use super to buy property? And the third segment looked at how SMSF property loans work. I think it's also important to go through the SMSF property rules that everyone should understand.
Yeah, look, so these ones are very, very important. And the ATO, the Australian Tax Office, is the regulator of all self-managed super funds. And they have setting some rules that must be adhered to make sure that your SMSF remains compliant. So what are some of those rules? Let's look at rule number 1. Your SMSF must pass what is called the sole purpose test. So that sole purpose test simply means that whatever decision that you're making to make the investment funds of your self-managed super funds are there to maximize your superannuation or your nest egg. So anything else that you should do, it should always be passing that. So whatever you're doing, is it in the best interest of maximizing that self-managed super fund? That's number 1, very, very important. Then number 2, there is no personal use of assets. So this one is crucial because whatever you're doing, for example, in that property, you or anyone that you're related to cannot live in that property. You must have a lease agreement in place, and the people that are living in there must be people that are not related to you. There is, however, an exception to this rule, and this is when it's a commercial property. So if your SMSF has a commercial property, then your business that you own can actually use or operate from the SMSF property or from the SMSF premises. For example, a motor mechanic might form an SMSF, buy a workshop, and their business can work from that workshop. That's allowed. Or the most common ones that we have nowadays would be an NDIS. So you have an NDIS business, and your NDIS business can actually be renting off your NDIS property that is owned by your self-managed super fund. So that's the exception to the rule. However, that business must be paying rent to the SMSF at market rates, and there must also be a rental agreement as well. Number three, all transactions that happen in SMSF must be at arm's length. So for example, if you are buying a property, then that property, you need to make sure that your SMSF is buying at market price. Or if, there's a tenant that is coming to live in there, then they are also paying rent at market rates. Or if, someone who is coming to make some repairs on your SMSF property, you need to make sure that you've done considerable inquiry to make sure that they are going to be paid their rates or whatever they're charging you at market rate. So in other words, your SMSF must not overpay for anything or must not be overcharged for anything. Everything must be at arm's length. The fourth rule, your SMSF must always complete annual audits. So at the same way that you do your personal tax returns every financial year, your SMSF must complete the SMSF tax returns, and those tax returns must be audited by a separate company from the one that have prepared the reports. In other words, that's just for check and balance. And then the fifth and the final one is that there must be a proper structure that is in place. So if you are borrowing, then your SMSF should be set up correctly, normally in what we call the corporate trustee structure, and there must also be what we call a bare trust that is now there to put in as a borrowing entity that is borrowing on behalf of the SMSF to get that loan from the bank. So once this is done properly and you do it right, then everything should be good. You should be in the green light.
These rules are not just some easy YouTube DIY type of investment rules. These are deep, complex, and strict rules that people must follow for the benefit of the retirement fund.
100%, 100%. SMSF is not for everyone, and everyone should engage a professional to make sure that they're being assisted and they're doing the right thing at every step.
So those are all the rules. We've heard about what it is, what it does, and how one can invest using SMSF. But what are some of the benefits to it?
Once done properly, Tabo, SMSF provides some very good benefits, which I'm going to outline. The first one is basically, you continue to enjoy the tax advantages that are there in superannuation. So what are those tax advantages? Those tax advantages are the capital gains tax. So for example, if you buy a property now and then you sell it in retirement, then there are some concessions in capital gains tax that you pay on those capital gains. And secondly, it's a certain age of 16 onwards, then you can actually now convert your property to now provide you with a regular income, and that income is tax-free. So there are some huge tax advantages that are inherent or that are there in self-managed super fund. And then the second one is, your long-term control of your assets. So if you've got your super in, let's say, an industry fund or a retail fund, you don't have any control of how those assets are managed. However, with self-managed super fund, then you have control. You have got control of what you can buy, what assets you can buy. And it's important that, along that, you're going to be buying good quality assets. Otherwise, if you don't have an eye for that, then you're probably better off leaving your super where it is, because that asset must be a good asset or a good property that you'd be investing in.
And for people nearing retirement?
This can be powerful if it's structured properly. However, what I really advise or recommend people to do is if you're nearing retirement, let's say you're only a few years later to retirement, then it might not be advisable to be opening a self-managed super fund and then borrowing money to buy a property, because you're nearing retirement, which means you might not have enough time to pay off the loan. So probably not the best strategy for someone who's nearing retirement. You need a bit of some time to make sure that loan is paid off, as well as providing you that money or that liquidity that's available, because in retirement you've stopped working, you now need that money to be paying your bills and all that. So if you're going to buy a property and there's still a big loan, you might not have time to pay that off.
And in our, I like to think, considerate, realistic, and strategic way of thinking, we might consider the benefits, but it's also important to consider and look at the common risks and mistakes of SMSF property investing.
So the ones that we have seen quite commonly is where someone opens or starts an SMSF purely to save tax. They're not considering any of their retirement goals, or the primary goal is to save tax. So if you're doing that, you are basically opening that SMSF for wrong reasons, and that would be a recipe for disaster. The second mistake that we have seen is buying the wrong property in a wrong area, or overcommitting. So in other words, let's say you're trying to make your investment grow, but you are buying in an area where there's no capital growth, or there's little capital growth in that area, or buying in an area where the yield is very, very low. So which means that when the yield is very low, then there's no enough money coming into the SMSF, and at some point some people may be forced to actually be pumping money out of their pocket to now fund the loan because the SMSF is not bringing enough money. And then the other common mistake that I often see is where people forget about contingencies in SMSF. So basically using up their balance towards the deposit and forgetting that on a rainy day, that needs to be covered. For example, if they don't have tenants, then who's going to be paying the loan? Or if there's major maintenance or repairs required at that property, or even interest rates going up. So most people overcommitting and making sure and not leaving money for contingency. It's another big mistake that we often see. So it's very, very important to consider that buffer that's put in place to make sure that in case of those things happening, then you've got something to fall back on, not having to force you to pay out of your own pocket. The third mistake is over leveraging, over borrowing, over committing. So banks usually, as I said before, they require you to have a deposit of about 20 to 30%. So some people get excited about, if I've got, say, 200,000, then I can, buy a property worth $1 million. That's overcommitting because there are other factors that are considered to determine the property price. For example, your age. If the older you are, then you may not have time to pay off the loan. Or you need to look at your super contributions coming in, how much money is coming into your super overall. So there are people that have been caught where, they're over borrowing, over committing, and then they're now forced to be paying money out of their pocket to fund that. And whilst we're on over leveraging, the problem with over leveraging, besides the fact that, you have overborrowed, it also means that come retirement, say 67, because you have overborrowed, you still got a balance in your SMSF, but your income has stopped. So you still need to be paying the loan off. So when that happens, you are now forced to sell that property. And sometimes it can be what we call fire sale. Fire sale means you now have to sell because you need to pay off the loan. And sometimes you may be selling when markets are down. So all those things that I just explained come as a result of overborrowing, which, most people need to be careful about. Mistake number 4 is not understanding the SMSF cash flow. And this is very critical and important to set it right in the first instance at the beginning. Because if you don't understand the cash flow, then it means that when the time comes, you've already, committed into your self-managed super fund, you've paid the cost and all that, and the property has been bought. But because you don't understand the cash flow, there are some expenses that you might have overlooked on the property. For example, cancel rates, cancel insurance, the property maintenance, and things like that. So you need to make sure that before you commit, you understand exactly what the cash flow of that SMSF would look like before you jump in. And then the fifth one, which is a no one, is breaking the SMSF compliance rules. So this is very critical because, Big Brother will be watching every move that you're doing, and any mistake that you do, then it could make you, it could put you as a trustee in a very, very bad position with the ATO. The examples of that would be early access of your super. So there's money in there, and then you probably use the rent for personal use. Or I've had some people that they use super money to fly to Queensland, for example, to go and do property repairs. Or other example would be because the fact that you cannot have anyone that you're related to living in that property, including yourself. I've seen some naughty people, living in an SMSF property or having a relative doing that. So those are basically rules that are put in there to make sure that it's protecting your retirement fund. And whether you are doing those deliberately or not deliberately, you cannot use an excuse that you didn't understand or you didn't know. That's why you did that. So, the regulators are very, very strict on what can and what can be done. So in other words, from all what I've spoken about, SMSF investing is not advanced investing. It is simply a structured investing. It's structured investing in a way that you need to follow the structure, you need to follow the rules, and you need to always be mindful that this is there to maximize your retirement nest egg.
So after going through the benefits, risks, and common mistakes of SMSF property, who, in your professional opinion, do you think SMSF property investing is best for?
So look, this is a question that a lot of prospective people that are looking into SMSF ask. They are very interested to know. So in terms of the super balance, they must have a super balance of at least 200,000 plus combined. There must be people that are long-term thinkers. In other words, they are investing for the long term. I would say 10 years plus, because in property, you're not going to be making any significant capital growth in a time that is lesser than that. Say 2, 3, 4, 5 years time frame, you're not going to be, maximizing the capital growth in property. And then there must be people that you've got stable income, because income is one of the things that you need to maintain your SMSF, because that's where your super contributions would come from. That will help you to pay off the loan. So you need that to be stable. Or if not, just, for example, to have a contingency plan. For example, due to illness or injury, making sure that you've got some arrangements in place to cover that income drop or income stopping from illness. It also suits those that seek control of their investments than being invested somewhere else in an industry fund or in a retail fund than the one that control themselves, where they can do that to buy a good quality investment. SMSF definitely will not suit for those people with the lower balances. So I would say that magic number is 200,000. If your super is less than that, then you cannot start an SMSF. It doesn't suit you. Short-term thinkers, those that are looking at 1 or 2 or 3 years to make a killing, then definitely doesn't suit you. And then people that think that they are looking for an asset to buy for lifestyle use, then again, that doesn't suit them. Plus, also those people that may need their superannuation to be in liquid form. I give an example earlier on. Say, for example, when they're nearing retirement. So you are 2-3 years before retirement. You know that you're going to be needing your super in retirement to give you a regular income. So if you're buying a property, then it's probably not going to be providing you with that regular income. So that point is probably related to that time frame that we spoke about earlier.
That was a big pull. We went from what SMSF is to what SMSF property investing is, what it looks like, how different people can use it, who it's best suited for, benefits, the risks, and common mistakes, and most importantly, the rules around it. But to answer it one last time, can you use super to buy property?
The answer there is yes. But the better question is, should you? SMSF property is powerful if it's aligned to your long-term strategy.
That's it for the Property Punch podcast. Make sure to subscribe, share it with a friend who might be interested in SMSF property investing, and be sure to come back for our next pour. Sip smart, invest better.